Hi, this is CFRM Group 3 and we're going to be presenting on Citi after the music stopped. After the merger between Travelers Group and Citigroup created the financial conglomerate Citigroup in 1998, the company touted itself as the first true global financial supermarket. Fueled by the perceived benefits of cross-selling, diversification, and cost savings, Citigroup raced through the early 2000s generating outsized revenues, profits, and return on equity, peaking in 2006. After years of growth assisted by steady acquisitions and an expanding global presence, Citigroup found itself exposed to its excess credit derivative portfolio and MBS risk. The ensuing housing crisis and credit crunch eventually led to Citigroup being deemed a systematic risk and its need for federal government assistance. The tremors that preceded what was to come in 2008 can be found in 2007, when Citigroup experienced a series of write-downs related to the quality of credit and value of various securities in its inventory. These included write-downs totaling nearly $3 billion from highly leveraged finance positions, subprime mortgage holdings, and consumer credit. At this time, the company stated that it had a roughly $55 billion exposure to CDOs. By 2008, the credit and housing crisis was in full swing. Like most financial services institutions, Citigroup was hit hard. As various financial services institutions began failing, the investors became worried about liquidity and overvaluation of securities. Credit markets froze. Citigroup saw its share price drop from $14 to $3 per share within 2 weeks. Eventually, the bank needed 2 rounds of federal funding to stave off possible failure. A closer look into Citigroup's balance sheet reveals that the company consistently increased its risk profile over the years. This was driven by then CEO Chuck Prince's drive to increase earnings. In particular, the company increased its exposure to mortgage-related assets. After years of moderately increasing its VAR relative to earnings, Citigroup's VAR spiked by roughly 43% and 106% over the years 2007 and 2008. The sudden increase in VAR in 2008 is due to incorporating subprime group exposures which were previously not covered by VAR. Unfortunately, VAR is only a measure of market risk, not credit or liquidity risk, and therefore the company was unprepared for the devaluation of its credit portfolio and mortgage-related securities. As market conditions worsened for participants, many anticipated the collapse of Citigroup as indicated by the doubling of its credit default spread over the course of 2 weeks. We attempted to quantify the probability of Citi experiencing such losses by fitting a heavy tail distribution to its historical monthly returns data. We found that the probability of the market events occurring was less than 0.5% for each month between October 2008 and February 2009. To conclude, we see that Citigroup was not prepared for the extreme events that happened in 2008 and 2009. The bank should take greater precaution to manage their credit and liquidity risk and adjust their models to better understand such risks. Thank you.